we going? Hello. Welcome to this week's Constant Investor live stream, and thanks for joining me at such short notice. And it's a different time, of course. It was just because I had something on yesterday that I couldn't get out of, and we'll be back to 1 p.m. on Thursdays next week. And yep, I had a week off last week. It was great down at Aries Inlet for most of it. It was pretty cold, but we had the fire on. It was very nice just to just get a few days off and to relax a bit. That was great. I've come back with a few changes to the product. One is that you may have noticed we're doing CEO interviews every day now, so we're just absolutely blitzing the CEOs. There's no escape from us. We're interviewing one a day. The CEO. There was Bill Morrow last night. Andy Penn from Telstra up today. I interviewed him last night from the ABC. So really looking forward to that. I love interviewing CEOs, both small and big companies. And I hope you like the interviews. In addition to that, of course, we've still got the fund manager interviews that James Brandis does each Tuesday, and each Thursday, instead of talking finance, the kind of program we were doing, we'll just interview an economist and sort of catch up on the latest economic news. That's Thursday. And the other thing is that Stephen Mayne is going to join us permanently after filling in for me last week, and he will do an interview with a chairman each week. So we'll have a CEO every day and a chairman once a week, a fund manager every once a week, and an economist once a week. That's the structure of the product, and I hope you enjoy Stephen's contribution. And also he's going to write a fortnightly column on corporate governance and capital raising issues. So he'll alternate with Percy Allen on each Thursday. So, but I'll describe all that in more detail in the overview on Saturday, tomorrow, just to clarify all that. And don't forget, this live stream and my answers are general advice. It may not be appropriate for you. And the first question today is from Andrew about Stephen Mayne. He says, "Bugger, I thought Stephen Mayne might have been a guest." So I wrote this question for him. "Hi Stephen, welcome to the Constant Investor. In your opinion, who is the most effective shareholder activist in the world? And what strategies, tactics and personal qualities make him or her so effective?" Well, clearly, Andrew, the best shareholder activist in the world is Stephen Mayne. And he's becoming part of the Constant Investor. As to what the strategies, tactics and personal qualities are that make Stephen so effective, it's probably a question for him, but I think the main thing is he really means it. I mean, he's not in it for personal gain. He's in it because he believes in what he's doing. I mean, there's a lot of shareholder activists around the world, particularly in America, who run hedge funds designed to profit from their activism. And there are some here, for example, Alex Waislitz, who is a very effective shareholder activist, and and he does very well out of it. Elliott Management, the one that's going after BHP, they're a shareholder activist hedge fund, and they do very well out of it too. But Stephen, I just like Stephen. He's got a lot of integrity, and he's doing it because he believes in it. And he, hardly makes any money. It drives his wife crazy, I think. But I think that's an important thing. But perhaps we'll get him back. As for why he wasn't doing this live stream last week, well, he wasn't allowed actually by our licensee, the holder of our AFSL, because Stephen's not yet an authorised rep under the licence, and he couldn't answer questions. He can write for us, but he's not allowed to answer questions at this point. Maybe we'll sort that out later. Kuhn says, "On 20th of July, I heard the podcast on banks are buy with Brett LeMessurier. That was 2 weeks before Austrac hit CBA with alleged money laundering. So I'm wondering if analysts with their eyes, ears and nose to the ground didn't know about this bombshell coming. How would we know? And if it was known, how come no one talked about it before 4th of August? I know CBA won't get hit with $1 trillion as in fines as the taxpayers and the guarantors, but what about us, the shareholders? CBA will certainly get hit, but the quantity is unknown. Does anyone know? Well, I think you make a very good point, and obviously Brett Lemessurier didn't know about it at that point when I interviewed him, and at that point you'd have to say CBA was not a buy. The other banks possibly were, but because they've gone up since then, but the CBA's gone down because of this Austrac thing, and I think it's really going to be interesting. I mean, this is the point that Greg Metcalfe, the chairman of ASIC, made, because he raised the question of whether Commonwealth Bank was conforming to its continuous obligation, continuous disclosure obligations in relation to Austrac, in not telling the market about it, because it was around for a while. I think Austrac first approached CBA with these allegations 2 years ago, and CBA has been sitting on them. And so I think this will be a big issue, possibly come after we find out what the fines are and so on, and whether or not there is a case for a class action by shareholders against CBA for not telling them about the Austrac action. And I believe that if there is a big fine and shareholders do take a hit, I think I reckon it's an absolute lay down misère that there'll be a class action against the company from shareholders to recover their losses. And it's certainly true that nobody knows at the moment what the fine is likely to be. Obviously, we don't even know whether they're going to be prosecuted. We know that, or convicted at least. We know that they're being prosecuted by Austrac, but as to how the court will find, we don't know, of course. I agree with you. I don't think it'll be $1 trillion, although theoretically that's the maximum fine. But it could be a painful fine, and it could well be a fine that requires them to raise capital. So if it is a painful fine that requires them to raise capital, I reckon that's class action city. That's for sure. Giles asks, are there enough batteries in the world for us all to be driving electric cars? If not, what is the alternative? Maybe fossil fuels or different battery technology. Well, of course, trains used to be powered by fossil fuels, steam trains. But yes, look, I think it'll be a very long time, Giles, before we're all driving electric cars. And clearly there's not enough batteries in the world now to power them, that's for sure. But the expectation is that, I guess, that there will be when the time comes. But I think it is the case, and this is part of the thing I've been on about in the Constant Investor in my overview a few times now. There is a shortage of lithium for the lithium-ion batteries, and there is a rush on around the world to develop lithium mines. It's a bit of a gold rush mentality going on. There's lots of interest, as Dave Thornton reported from the Diggers and Dealers conference in Kalgoorlie last week. It was all about lithium in Kalgoorlie, not gold. So yeah, look, there is definitely a rush on. There is a shortage of lithium, and there are a lot of people trying to take advantage of that. I think that there's not much prospect. It doesn't seem like there is much prospect of there being a surplus of lithium that will drive the price down and cause problems for the lithium miners. So I do think that it's a pretty good thing to be looking at as an investment, and it's likely to last a long time. I mean, there are an awful lot of cars on the road, and I think that they will, over time, mostly, if not all, go electric. I think that's pretty clear. We are coming to the end, in my view, of the age of oil. A lot of people disagree with that. We won't know until the time comes, of course, but I reckon that's what's going to happen. And your car will be one of your electrical appliances. Makes a lot of sense to me. Mark says, I don't believe I have seen the market so narrowly range-bound for a period of 3 months, as has been occurring. My gut feeling is that it is less likely to be a combination of issues, but more possibly the shadow of North Korea and a stand-aside attitude waiting on a direction. Well, I think you're absolutely right there. It is definitely a stand-aside attitude. Nobody really wants to take a bet on things. The Australian market is a little bit overvalued, not much, but it's certainly not cheap. And it's not too expensive that you'd expect it to go down. So it's at the sort of valuation level that would justify range-bound trading. In the US, everyone's just holding their breath. They've put on the S&P 500. The US market has increased substantially since Trump was elected, in the expectation that his policies would lead to higher profits. And now the market investors are just holding their breath to see if those policies actually come about. I think that the market is genuinely holding its breath. That's for sure. And as to what breaks it, I don't know, but I do think that the market's looking toppy, and I think that we've got a question later on about Trump. So I'll address that at the time, but I think that there are serious problems now emerging in relation to politics in the US. In fact, the question is from David. How worried are you that the rift between business and Trump, with the rift between business and Trump widening, that the adults may leave the administration and we wind up with damaging economic policy to add to the divisive social policy? Wall Street seems to be becoming more worried. Well, yes, and with good reason. I reckon the abandonment of Trump by the CEOs and business generally, and of the senior Republicans over the Charlottesville issue, means that we're starting to, I think, come to a head, really. And I'm addressing this in tomorrow's overview at some length, because I think it's becoming quite important for investors. It seems to me possible that we're coming to the point where there are two likely outcomes. One is that they remove Trump, the business community and the Republicans follow through with what they've kind of started this week, and just go all the way now and get rid of him. Or they just go back into their shell. Trump continues on, sees out his full term, but that he's kind of emboldened and almost freed, in a way, the protesters on both sides, and that basically civil order breaks down in the US. I think there's a serious prospect of disorder in the US now, and that is likely to be much more damaging for investors than anything. I mean, it's not one of those things that's probably not going to break out into a civil war overnight or something, but I do think that this week's events, last week's events, are seriously worrying, in my view. And I actually think that it's most likely that they won't remove Trump. Certainly the Republicans would need to, step up in a way that they have not been capable of up to this point. That's for sure. John says, I hope you watched Hawke and Howard in Conversation, hosted by Annabelle Crabb. I haven't, John, so that's still in my future. A very thoughtful and intelligent discussion of our disillusion with modern politics. John noted that the present highly unusual economic circumstances have combined low interest rates and low wage growth. Bob reminded us not to overlook the significant changes in China, starting with the move to a market economy in 1978, and the growth was no longer exclusive to democratic societies. To what extent do you think China is a factor in our current economic state, or do you attribute other factors such as technology and automation as more significant? It's a bit hard, I think, to develop a kind of a ranking of those factors, really. I mean, clearly China is a huge factor in our economy. and was responsible for the mining mineral boom, obviously the investment boom, and to some extent responsible for the decline, the end of it. So, you know, I suppose you'd have to say China is the most important factor in the Australian economy at the moment, has been for quite some time. But there's obviously more to it. There's, as you say, technology, which is a huge factor in terms of the wages growth. I think that a lot of it is to do with technology, and you know, the fact that the workers don't have any bargaining power at the moment. And I think we've got a question about Dick Smith a bit later. Yeah, so John says, interested in your thoughts on Dick Smith's assertion that it is unchecked population growth contributing to stubborn low wages, the housing affordability crisis, and the widening gap between business profits and take-home pay. So this is interesting in the context of your theory on technology as the main cause of the problem. Even with all this going on, the Australian share market is trending sideways, and average property prices with 80% gearing keep going up. That's right. So the point I've been making for a while now is that per capita economic growth is pretty flat. The only reason we've had economic growth for the past 10 years or so is because of rising population. And rising population is definitely pushed by the business community in order to achieve growth in sales that they wouldn't otherwise be getting. And so the fact that Australia's average growth in population per annum has increased from 100,000 to 200,000 since 2006 has really made a massive difference to the Australian economy and has increased economic growth. So I suppose on the whole you'd have to say it's a good thing for those reasons, because without it employment would be much worse than it is, to be honest. I mean, this is where I diverge from Dick Smith. I think that it isn't leading to population growth, is not on its own leading to unemployment. What it might be doing is adding to the lack of bargaining power of workers, which is why John Howard actually increased population growth in 2006 in the way that he did, because it was actually a part of his industrial policy and work choices. And what he wanted to do was to break the power of the unions by increasing population, which he did, and I think that it actually worked. Unions, the decline of unions accelerated after that time, and that has contributed to low wages growth. So I think Dick Smith is right about that. It's obviously contributed to housing affordability problems because of the demand for housing being so high, and as you say, the widening gap between business profits and take-home pay. But the thing is, I think the problem is not so much the population itself, population growth itself, but the fact that the governments, including both sides of politics really, have increased the population growth, but have done nothing else. They've just increased the population growth. They haven't actually gone about spending money to ensure that we can handle it. And that's what needs to be done. I think that the increase in population is right, but I suppose I do agree with Dick Smith that if they can't build the infrastructure required to handle a population, whether it's roads or housing, or other infrastructure, energy, for example, then they should just cut back the population growth. So I suppose I agree with that. It's really what I would rather see is the infrastructure to handle the extra people, and for Australia's population to keep growing. Alan, your 4D interview was great and prompted an interest in some research into global infrastructure funds. Is there a resource that lists and compares the funds available within a particular sector, e.g. global in infrastructure? Not that I'm aware of, Michael. I'll have a look. I'm not sure. I mean, it'd be great, and maybe that's something we could put together in some way. We've certainly done that with our ebooks on investing in Europe and India, which took a bit of work, where we're trying to find, in particular, funds that invest that people, individuals in Australia can invest into Europe and India with. But yeah, I haven't thought of it for infrastructure, and I think it's probably something we should do. So I'll get back to you on that. Mark says, Alan, you have mentioned that you personally invest predominantly in shares and funds and not ETFs. Have you found a way that how you might use Percy's market timing to optimise your asset allocation? What a good question. I haven't. Percy is very focused on ETF, market timing using ETFs. To be honest, I'm not a market timer myself. I don't really want to. I don't really want to do it. My preferred method of investing is simply to pick some good companies and stick with them until they don't deserve to be stuck with anymore. That's kind of where I'm at. But I do recognise that firstly there are a lot of people who are interested in market and timing the market, which is why, of course, we acquired Percy's newsletter, Market Timing. And secondly, it is true that there are times when it's not a good idea to buy, and there are times when it is a good idea to buy, and vice versa. And really, the basis of Percy's idea, well, the reason he set the thing up, was to try to protect people and himself from market crashes. And I suppose that's the thing. So yeah, look, it's not so much to use market timing to optimise asset allocation, although you could do that. I think it's the way to use market timing is the way that Percy intends it to be used, which I think is to protect yourself, mainly to protect yourself from crashes. And I would do that. If Percy puts out a big sell, then I will listen to that, even though I don't own ETFs. Mark goes on to say, Alan, a couple of weeks ago you talked about recommended cash allocation within your investments. Do you factor the amounts of cash maintained by fund managers within your portfolio into this consideration? No, I don't actually, and I tend not. Well, I don't invest in many fund managers, and those that I do tend to be fully invested because they're LICs. So, for example, Baylor Thorney Opportunities Fund, which I've got some money with, aren't really asset allocators in that sense of having a sort of a proportion of cash. If they've got cash, it's because they haven't found anything to invest in for a while. So look, but I do think that if you do invest in fund managers that are asset allocators in that way, for example, if you invest in a super fund, then you should be taking that into account as part of your cash allocation, that's for sure. Kim asks, what is your take on graphene companies? I've recently invested in Ionic Industries. Do you follow graphene companies? Any insights would be warmly received. Yeah, look, I don't know much about graphene except that it's a wonder thing, and it's fabulous. I think, I don't know. I need to focus more on it. And what I might do is interview Ionic Industries. I have heard of them. I think they're a very interesting business, and there are a few graphene companies. It does seem that graphene has been a bit sort of overshadowed by lithium lately in terms of the new materials going around. But I think it's worth keeping an eye on. So I'll undertake to interview either Ionic, if I can get them, or somebody else or somebody else. So there you go. Kim goes on to ask, what is a good yield at the moment? Okay, I'll look in my iris screen to see if I can do that. Yield. Okay, so in the All Ordinaries, the best yield is CSG Limited, whatever that is, at 11.5%. and Sky Network is yielding 10%, and there's a few at 10%. Now, the only thing I'd say is that there's a lot of companies, and I don't know whether those are among them. A lot of companies are on a high yield because they're terrible stocks, and the price is where it is, and the dividend is where it is because they need it to be, because otherwise they'd be down the drain. So I'd be careful. Once you get over 6% yield, you're starting to take risks, I think. And a 10% yield stock, which you can find, as I say, there's Vita Group is 10% yield, Quintus is 10%, and Cab Charge is 10%. So there's 4 or 5 10% yielding stocks in the All Ordinaries Index, and I reckon before you invest in a 10% yield stock, you'd want to be very careful. You'd want to do some work on them and make sure that you weren't going to blow up 5 years of dividends in a couple of months through the price falling, because that's what can happen with those stocks. Let me have a look. What else questions we got? Oh, Stephen Main. Hello, Stephen. Stephen's with us today, and he's asked a question. Hi, Alan. If Trump resigned quietly tomorrow, citing ill health, do you think the US share market would go up or down on Monday? Actually, to be honest, I suspect that the market has now discounted his policies, and he has become irrelevant. I know that's a big statement, and I'm not saying that he's irrelevant to the world by any means, but I do think that the market has corrected, and I reckon the fiscal stimulus that he promised and the tax cuts that he promised are out of the market now. Possibly more likely to go up than down, because there'd just be Mike Pence, President Mike Pence, and he seems to be crazy in his own way, Mike Pence, but perhaps not the same way as Donald Trump, and hasn't yet discovered Twitter, it would seem. So that's a plus, and so the market might go up if he resigns citing ill health, and we can only hope. Mind you, life will get a bit more boring if Trump resigns. What do we all do? We'll have to go back to our lives. Nothing to see here. Move along. This is a long question. Heavens above. Am I supposed to read this question out?
It's a bit from the Washington Post if you want a quick browse.
Yeah, right. Okay. So he's included a long quote from the Washington Post about a possible China-Indian war. Heavens above. I just haven't got time to read it, David. So I'll have to get back to you on that. I really don't know about China-India war. There's been talk of China-India wars for a long time, and I reckon we've got more problems than that going on with North Korea. But yes, there seems to be a standoff, as you say, and I mean, they're both nuclear armed now, so maybe they'll drop bombs on each other. Who knows? Remember, this live stream is general advice and may not be appropriate for you. I've got Richard Goyder from Wesfarmers. I'm interviewing him this afternoon. We'll publish that on Monday, and I think this might be my last interview with Richard as CEO of Wesfarmers, which will be a momentous time, because I've been interviewing him for many years, and he's always been a very pleasant person to talk to. I'm trying to get Paul O'Malley from Blue Scope Steel for Tuesday, because now we've got this treadmill of CEOs every day, so we've got to come up with one every day, which is great, but a bit of a rod for our back. But it's we should be right. There's plenty of, particularly during the profit season, there's tons of CEOs making themselves available James is speaking to Peter Wilmshurst of Templeton Global Growth, who disagrees with my comments on Europe bubbling. He sees some value in European banks. Did I say it's bubbling?
Yeah, he said it's bubbling.
Oh, okay. I said it's bubbling. There you go. Dave is speaking to Alex Pollock about his excellent top stock picks. No changes, but some impressive updates. And Percy Allen will have another editorial column for us later this week. And the following week, it'll be Stephen Mayne. And I think Stephen is going to do a chairman for us next week, or at least he's going to try, which will be good to start that. We're also very pleased to have Stephen on board. I hope you're still watching, Stephen. It's great to have you on. We're looking forward to working with you. Thanks for your company this afternoon. It's been good. And I'll see you in your inbox with my overview on tomorrow morning.